We're back once again with Peter Hodson. And Peter, you were saying small caps are getting ready for a long overdue rally?
It really is long overdue. We've had, I think, 7 false starts. We started doing okay in
Robert the Bruce territory.
Exactly.
Now. At this time, it'll be 8, though.
Up until April, everything was starting to click in. And then, of course, we had Liberation Day, and that ended the party. But what's happening right now is generally small caps are way more expensive than large caps. And when you think about it, that makes sense. They have better leverage to growth. It's easier to grow a $100 million company than it is a $4 trillion company. They don't have a lot of debt because banks don't like lending to them. So there's not that much risk, even though their stocks are volatile. And now you've got a situation where they're actually cheaper than large caps. And they're still growing faster because they're inherently faster growing. Now, if you look at just the small cap index, the Russell 2000, it is more expensive than the S&P, but that's because there's a lot of companies in the small side of the equation that don't make any money. If you eliminate those, the price earnings ratio dips down from about 30 to 17 versus 22, 23 for the S&P. So now you've got faster growth at lower valuations. And all you really need is lower interest rates and confidence, and small caps will start to go. You're also starting to see a lot of M&A activity in the small cap space. We had Dental Corp taken out. We're getting pretty much every day there's a new announcement of a small cap either going private or being taken over. So once you get that combination of growth, valuation, confidence, rates, and merger activity, and small caps can do really, really well. I don't want to make predictions because 7 times we've been hit in the head so far. Yeah. But it's one of those situations where we're very much long overdue for a rally. And once that money flows into the sector, the supply-demand of money, there's small companies with a big amount of money coming at them. You can get very, very big moves. And
are there subsectors that are looking better than others? I mean, gold has been kind of driving everything.
I mean, gold, the small cap gold sector has just gone absolutely crazy. I mean, I think the gold index on the small cap sector is up 127% this year. I mean, just ridiculous. But that's the kind of leverage when there's a money flow that goes into a sector. We think industrials, they'll benefit from the onshoring in North America. We think tech, you're going to see a lot of small cap techs do well as all that money flows sort of down through the system, not only from company to company, but as investors move further down the ranks. Crypto, again, it's not our expertise, but you're seeing all these crypto companies do spectacularly well as the prices keep going up and there's more trading. Forestry and other resources, you got to wait for tariffs. But I think, and some of the consumer discretionary companies could do very, very well. And you're starting to see big moves. And more importantly, you're starting to see some volume increase in some of these stocks. So it is encouraging, but 3 months is not quite a trend. I mean, these things can go for a couple of years when conditions are right.
Patience with this by the sounds.
Yeah, and just watch out for volatility. Everyone says, oh, they're too risky. But a lot of them are risky from a stock point of view. Yeah. They bounce up or down, but not from a financial point of view.
So if you're holding on to it, if you're going to hold on to it for a while, you just have to ride those.
Exactly. I mean, don't be scared off by a 10% decline. I mean, that's just commonplace in the small cap land. If nothing's changed at the company and you're down 10%, don't worry about it.
What would be a red flag for you then?
So when there's a change, either a CEO change or competitive edge change, like if there's a new competitor comes to town, or if there's a financial risk change, like a company goes out and makes a big acquisition and suddenly they went from debt-free to $400 million in debt, that's a little bit worrying. When you have consistent missed execution, I mean, small caps will only do well if they get more buyers, obviously. But if you promise too much and then continually miss expectations, you're not going to get that valuation bump that comes from new investors coming in.
And what about what could derail this, the optimism?
Probably
overall, just an overall.
And in the regular market, inflation, interest rates have to go the right way. Absolutely. You've still got a lot of potential black swans with all the wars going on and things like that. But really, it's just earnings. Right now, we're in a sweet spot where earnings are good and companies are spending money. But if that spend doesn't translate into new profits, they're going to stop spending, and that starts a cycle. A little worried about the housing market in Canada. The housing market has saved us from every other disaster. And this time, I mean, there's been a 16% decline since 2022 to now in terms of average housing prices. And that's the biggest since records were kept from 1975. So that sort of source of wealth is disappearing. And that it is a big driver of both economies. So that's one of the risks.
The well is drying up. Potentially, yeah.